and welcome to ETF Edge, your go-to place for everything exchange-traded funds. I am your host, Bob Pisani, but you knew that, right? After huge inflows last year in short-term treasury and money market funds, 2024 is already seeing some change in investor sentiment towards bonds, and that's our topic today. What's in and what's out in bond investing? Let's talk with David Botzett. He's the Schwab Asset Management's Head of Innovation and Stewardship. Schwab is the fifth largest ETF provider with over $300 billion in assets. Also here, remote, Nate Geraci, ETF store president and an all-around expert in ETFs. So, David, at the last ETF conference, last week we were in Miami Beach, you and I, chatting, and we were talking about 2023. It was the year short-term treasuries. It was the year money market funds. But 2024 seems to be shaping up to be something a little bit different than that. What's going on? Where's the flow? What are you telling people?
Yeah, we're seeing more flow in the intermediate space of the fixed income curve. I think people are starting to realize that we're kind of at the peak of interest rate increases, so they're looking to reposition the fixed income portion of their portfolio to take advantage of where interest rates are likely to go next.
So explain this to the viewers. The reason you should consider going from, say, a short-term fund, which is what, less than a year in maturity, to something that's more intermediate. Intermediate means what, 3 to 5 years?
3 to 5 years, sometimes out to 10 years.
And the reason you should be considering doing that is why?
Because when interest rates come down at such point, you not only get the income from that bond, you get price appreciation, because yields and prices of bonds are the inverse. So
basically, they're not going to be, rates are going to be coming down, the shorter term rates, your expectations.
Yes.
And going towards the intermediate side of the curve there, the middle of the curve, the chance of them coming down is less? What's the point here?
In most cases, it is less, and that's what the yield curve is showing us. It's the yield curve, you're actually seeing higher rates on the short end,
right?
But the long-term expectation is where those intermediate terms are today. So you'd likely see that less likely for those to come down. You'll be able to capture that yield for a longer period of time.
You know, Nate, you and I have been talking about this as well, and you've been telling me fixed income is a bit of a challenge for investors and even advisors right now. What are the issues as you see them, and where do you see the money going right now?
It's interesting because if you look last year, over $1 trillion went into money market funds, which made sense in many ways. Investors were content to scoop up 5% plus yields, call it a day. They didn't have to hassle with decisions around duration risk or credit risk or whether the Fed could actually orchestrate a soft landing. The challenge now, though, is should investors stay parked in cash, or should they venture out on the duration and credit spectrum? I don't think there's necessarily an easy answer here, other than if you stay parked in cash, you're obviously taking on the risk that if rates do come back in, you're going to leave some return on the table. I think to what David was speaking to, from my perspective, I think taking on some duration risk makes sense, but I wouldn't go too far out on the curve. I just don't, the risk return dynamics getting too far out on the long end don't make a ton of sense to me. On the credit side, I do think it makes sense to look at corporates. You don't just have to stay in treasuries as an investor. I would favor investment grade over junk. And if you look at flows this year in the ETF space, we have seen flows into that short to intermediate part of corporates.
So do you agree with David's point that it makes some sense to consider moving more into the intermediate part of the curve? Less chances rates are going to go, it'll be more stable. Does what David's saying make some sense?
I do, with the one caveat being that if we look at how the Fed has handled this battle against inflation, and even go back to a couple of years ago when they were slow to react as we started seeing the CPI data come in, if you're starting to go out on the curve, you're making the bet that the Fed is actually going to get everything right this time. And they very well may. The data looks like that's where we're heading, but that's not a sure thing. And that's why I wouldn't go too far out on the curve, because I don't know that, look, inflation data could still continue to come in hot. The last print we saw was higher than the market anticipated. So the Fed may stay higher for longer, and I just think you have to be cognizant of that as an investor.
So David, your point here is we're already seeing inflows into these intermediate term corporate bonds. Schwab's got a bunch of them. Well, how about, I like to flip it around. What are we seeing outflow from? We were talking about TIPS last year, Treasury Inflation Protected Securities. These are bonds that are indexed to inflation. So we should be seeing outflows, right? If inflation is going down, the value of tips should decline, right?
Yes.
And that was a very popular investment 2 years ago.
It was, and we did see that, especially in the second half of last year, where we saw outflows from the TIPS ETFs across the marketplace.
So outflows from there, and that makes some sense, right?
Yes.
Okay, we don't need it as much. All right. Now, I want to go back to Nate's point about corporate bonds. Corporate bonds had a huge rally at the end of 2023, along with everything else, guys. As you know, the yields gone down, prices up, but the yields have backed up, recently in the last month or so. So prices are down, but there's also been inflows here. And I want to show you the yield differential here. This is very important because here's your risk here. You're getting 5.6% yield for corporate bonds. I think this is your yield right now versus 4.3% for comparable treasuries. And again, I've been taking this off, I believe this is Schwab's, both intermediate term ETFs. So there's what you're getting compensated. There's your extra risk right there, 5.6% versus 4.3. Can you make an argument right now for owning corporates over treasury, given you're getting a 1.3% higher, 1.3 percentage points higher?
And I think I agree with what Nate was saying there is a case to be made right now where there is a yield pickup that's sufficient to warrant corporates over treasuries at a similar duration level.
Yeah, so
you're getting 100 basis points in incremental yield there.
Yeah. So, do you agree with this, Nate? I mean, it seems to make sense to me if you're assuming right now that there is no imminent risk to the economy, that there's no credit risk, and I'm not even talking about high yield, I'm just talking about corporate. I think that 5.6 is fairly attractive versus 4.3. Again, assuming we don't have enormous risk in the economy, which would create, credit risk here.
And that assumption is the key. Yeah, the assumption that you just made, that's the key part here, because if the Fed botches this soft landing, then clearly that's going to present some risk to corporates. What's interesting to me is if you look at the flow data right now, so far this year, money has come out of ultra short and short-term treasury ETFs and even floating rate treasury ETFs. And we've seen investors going further out onto the curve into longer dated treasuries, as we've talked about earlier, but also on the corporate side. You look at the flows, we've seen flows into multi-sector bond ETFs, such as BND and AGG, and then on those investment grade corporates, particularly on the short and intermediate part of the curve. ETFs like VCIT and VCSH and LQD, those are leading the way. So investors are clearly circling around this area right now.
Yeah. Honestly, as an investor, I made fun of my mother last year, who called me in March and said, Robert, I'm at the bank. She was a head bank teller for years at the bank. The girls are telling me I can get 4% of my one-year CDs. She said I was getting 0.3% now. And I said, Mom, that's a good deal. And she said, well, Robert, I'm excited about it. I said, well, the banks are not, because they're going to have to pay you more to keep that money in your bank account and not put it in a one-year CD. And she said to me, Robert, I could care less about the bank's profitability. I got nothing from them for years. And millions of people did what my mother did, just what Nate was telling me about, including putting money into short-term bond funds as well as, money market funds.
I think that's exactly right. But when you start to think about those investors, I would argue that there's caution to be had. If your mother, she's taking it from her bank account to go into the CDs. Those are the dollars typically you're going to allocate to short and intermediate term bonds.
Yeah, she's not going to suddenly buy NVIDIA out of that.
Yeah, exactly.
Right, very sticky money. But 5 points, doesn't this strike you as more normal than it was a few years ago? Normal to me, 4 or 5% on a 10-year seems a lot more normal than 1% a few years ago. That people thought that was, suddenly got used to that, 3% 30-year mortgages. That's not normal. It never has been like that. And now everybody's whining that they can't get a 3% 30-year mortgage. I'm sorry. It was 11% when I bought my house in 1985. It's come down, thankfully, but 6% is a lot more normal historically than 3%.
It is. We've been living in this long bond market rally for so long. We're finally through that. We're in a much more normalized environment. I actually think it goes back to the old 60-40 portfolio, which 18 months, 24 months ago, we said was broken. And suddenly that type of allocation makes sense again because we're in a more normalized rate environment.
Yeah, I remember 2 years ago at the ETF conference, zero discussion about bonds because nobody wanted anything to do with it. Nobody's going to do it. And now look how fast things change around. Speaking of active management, Nate, I know you mentioned it. Active fixed income were a huge story at the exchange we were all at a week ago in Miami. So explain to the viewers, what does active get you in bond portfolios versus passive?
Well, first of all, just to your point, it was unbelievable. From my perspective, actively managed fixed income ETFs were absolutely the conference darlings at exchange. It was a huge topic, and it's crystal clear to me that ETF issuers are focusing on this category for several reasons. I think one, issuers see that there is white space here, because if you look at most ETF categories, they're pretty saturated, but active fixed income is one where issuers believe they can still offer some value and perhaps innovate a little bit. And that really gets into your question that, I think the value here is given the market dynamics that we were just discussing. I think some investors, because of that challenge, they're comfortable handing the keys over to an active manager to help solve that. Does the Fed get this landing correct? Should you take on duration risk? Should you take on credit risk? Instead of an investor or advisor making those decisions, they're more comfortable handing that over to an active manager to solve. And I think the other thing here too, Bob, is if you look at the historical track record of active management, you and I know the data very well on the equity side, which isn't good. The data does look much better for active managers on the fixed income side. And so I think investors and advisors are a bit more open to active management within fixed income compared to the equity side.
I guess the question is, how much real value is this going to add in the long term? I mean, Nate hit upon the key point here. Indexing is pretty saturated. I mean, we've got all of look how successful Schwab was in moving into this space. You're the 5th largest provider, largely on indexing.
Yes.
And you guys just moved right in because you have such a large base of users out there. You were able to successfully, make a big splash in the ETF space. And yet we know the industry has to grow, and the way to grow is by active, because that's not saturated. My question, though, as an old Jack Bogle disciple, is, are they really adding a lot of value? Do you feel, I mean, Nate apparently thinks that they are. Some of them probably do. Are there advantages to being active? I'm dancing around the question, which is there something unique about bond trading that allows quicker innovation? The guys in equities, they always say, oh, wait till volatility comes. That's when the active guys are really going to do well. And it's never proved to be true. Yeah. They generally do not. Is there any academic evidence that active management in bond funds, and they can react quicker, will make some kind of I'm trying to make a case here for the viewer. Why would I bother? Why would I add, if I have a nice portfolio of ETFs that are indexed, what is the value proposition in adding active management? Does it help? Does it do outperformance? Does it tamp down volatility?
Well, I think you look at it and you say, what's the bigger concern of my portfolio? If it's cost, indexing is the way to go. If you're looking for the potential to outperform, active and fixed income has demonstrated the ability to do that over time. Let's just use aggregate bond index. It's one that many ETFs track. Well, the exposure you're getting to treasuries versus corporates versus mortgages is dependent upon the amount that's issued in each of those categories. You're just tracking that index. Over time, it's performed well, and managers can demonstrate they can closely track that index. But if you think in this environment, that should be more heavily weighted to corporates over treasuries because of the yield differential, that's something that an active manager can do.
Yeah, you get my point here, Nate, right? You're an average guy like me, and you got an index portfolio of S&P and small cap value, et cetera, in a global bond market. Could you make a case why I would add an active management component to this? Does it tamp down volatility? Does it improve returns? What's the value proposition here?
Well, look, first, I think I am an old school indexing proponent, and so I think it's always tough to beat index-based investing. That said, my experience is that a lot of investors and advisors, they're very comfortable when it comes to the equity side of the equation, doing some active management on their own, but they're not as comfortable in the fixed income space. And so when the environment is challenging, like I think we're in now, because again, while yields have come up, we haven't had this type of environment for several decades. And so I think that they're much more comfortable being able to outsource that to an active manager and feel like maybe there is some value proposition there that they can squeeze out a little bit of extra yield without taking on as much risk. And if you look at the historical data, it is better for fixed income on the active side. Still not great, but it makes sense to me why investors are looking to active managers in this environment.
Okay, I want to move on. You get my point, folks. I'm skeptical about the active management thing. Remember, they charge more, so the alpha has got to be even more pronounced to make up for the higher costs. Okay, Jack Bogle, got to go back to that.